Okay guys, hi guys and welcome to the Wave Matrix Traders Classroom and myself Bharat Junjunwala and I'm the founder of wavemetric.com. You can visit our website to see the ambit of services we are providing, and today we are going to discuss the option strategy. It's the Iron Condor strategy, and we'll look what is this strategy all about and how we create this strategy and how can we take advantage and benefit of the strategy. Further, we have a mobile application, the Webmetric mobile application that is available on the iStore and as well as on the Play Store. Here we have an option segment on which we keep updating our strategies. So if you are interested in learning option or looking into our option strategies, you can download this application from Apple iTunes or Play Store, and you can keep visiting this option strategy tab where you can see how we play with our option strategies, that we keep updating it from time to time. Also, we are providing services in equity, futures, options, commodity and forex research, and you will find it all on the different tabs on the same application on our Wavemetric mobile app. So download today and enjoy a host of services that are absolutely free for now. And let us begin our Iron Condor strategy that we were talking about. So this strategy is a limited risk strategy. First of all, that the risk is limited. You don't have unlimited risk. Secondly, it is a non-directional strategy. So when we are uh, creating this strategy, our view of the market is basically non-directional or a range-bound view. Suppose if you talk about Nifty, we have a view that Nifty is going to move around 8,000 from 8,800 to 9,200 levels. So this is a range-bound view of the market, and it's so you're not deciding a proper direction that yes, we are going to go up, we are going to go down. No, in the coming month we are thinking that Nifty will be a type of range bound movement of 100 or 200 points up and down. So this strategy is for a non-directional type of view. So this is a monthly income scheme, that is you have to create this strategy in the mid of every month for the next month. That is, we need at least 45 days to expiration for creating this strategy. So this will be a monthly income scheme, that is once you have created this strategy, this will be in force for 45 days and you have to keep adjusting it as we reach the break-even point that will come to later in this presentation. And high volatility environment is required for playing this strategy. So you have to rank your volatility, how you rank your volatility from, and this needs higher volatility, right? So we have ranked our volatility from level 1 to level 20. So when this volatility is around the fourth rank, what we have ranked the volatility according to the uh, points. So as the volatility is on the fourth ranking on our bars, so we enter this strategy when the volatility is at rank 4. And it's a combination of two strategies, basically the bull put spread and the bear call spread. So you can see what a bull put spread is and what a bear call spread is. So when you combine with these two strategies, basically an Iron Condor strategy is formed. All right. So how this strategy is constructed, we have to sell one out of money put, and to hedge this out of money put, we are going to buy an out of money put of the lower strike. So suppose we are selling an put of 8,800. So to this is selling of out of money put. Right now Nifty is around 9,100. So we sell, this is out of money. So we sell an 8,800 put and we buy an 8,500 put. So this is buying an one out of money put of lower strike. So 8,800 put we sell and the lower strike is 8,500. We buy a put on the lower strike. So when we are selling a put, we are basically forming an bearish view a bullish view, and when we hedge it, we are creating a put spread. Similarly, we sell an out of money call. So suppose 9,100 is Nifty right now, and out of money, say it will be 9,300. So I sell an out of money call here, and we buy one out of money call of the higher strike. So to hedge this, we buy a 9,500 call, say, of higher strike. So I am buying one 9,500 call with it. So when we are selling an call, we have a bearish view on the market, right? And to hedge that, we are selling a put when we have a bullish view, we are selling a call when we have a bearish view, and we are doing both of them when we have a neutral view, right? It will be something like this. So when we hedge it, it becomes a type of this. So what happens, that this strategy is formed when we are selling the call and the put and buying the later out of money call and the put, right? So this is the one thing. 45 days is the minimum period we have to look for. So suppose if we are planning to trade in the April month options, we have to trade it on 15th of March or before, but not later, because at least we have to take advantage of the time value, the theta. And when we are forming this strategy, since we are selling the puts and calls, we are going negative on vega and we are going positive on theta, right? These are the Greek that you can refer our other courses to understand what vega and what theta is. So this is how this strategy is formed. This strategy has a limited profit. That is, the maximum gain of the Iron Condor strategy is equal to the net credit received. Now when you are selling two out of money options, that is one call you are selling and another put you are selling, then you are getting a net credit in your account. Now this is a maximum profit that we gain from this strategy, and the formula for calculating the maximum profit is net premium received minus the commission paid. So it is the net premium received minus what you have paid for the brokerage or commission in your account. And when the maximum profit is achieved, it is achieved when the underlying strike price underlying is between the strike prices of the short put and the short call. That means if suppose we have, yeah, this was it, 8,800 and 8,900, sorry, 9,300. So we sold calls of 9,300 and we sold puts of 8,800. Now if we expire between these, then profit is achieved. So this is the maximum profit zone if we expire between these two, if the option expire between these two strikes. All right, so this is what it wants to tell. So it's a limited risk, that is the maximum loss of iron spread is also limited, but it is significantly higher than the maximum profit. So the loss is little bit higher than the maximum profit, but again this loss can be managed. And what is it? Basically it is called the option adjustment or option morphing. When you are doing these things, this loss can be managed, and so if you are actively managing your Iron Condor and you're every day looking at it, so it won't result into a loss. It can be managed very efficiently, and you will see that at the end of the expiration, whatever levels the index or the spot is, you remain in profit maximum and most of the time, right? And this is the formula for calculating of the maximum loss and maximum profit when you're using any option software, be it be option oracle or anything else. This will be calculated automatically, so don't need to go through the formula. I've just written it for the reference, so that if you ever need to know how it is done. So there are four legs, there will be two break-even points. In Nifty, the upper break-even point is the strike price of the short call, that is 9,300, plus the net premium received. Suppose we have received 100 rupees premium here, so it will be 9,400. So as long as Nifty or the option is below 9,400, we are at a break-even point. Similarly, strike price of the put, the lower break-even point 8,800 will minus the net premium received here 8,700. So as long as the option, the spot is above 8,700, we are at a lower break-even point. We have to do nothing, just be seated on the side and enjoy the market. We have to take action when we reach either of the break-even points. Then we have to take action, because crossing of any break-even point will start resulting into basically losses into our account. So we have to take action when we reach our break-even points. Next, this is the option chain of Nifty, and we see that 9,100 is the at the money call and at the money put. So we have to choose strike. So when we are willing to sell a leg for option, we have to sell the call leg, that is 9,200, and we'll hedge it with say 9,400. Similarly, when we'll sell the puts, we will sell say 8,900 puts and we will hedge it with 8,700 puts. Now there is a method to choose the right strike price that we discuss in our courses here at Wavemetric. So there are right methods to choose the right strike price also. So if you ever wanted to enroll in the courses, then you will come to know how we do it. So here it is this is the option oracle page, and here you can see that we have chosen 9,300 short call to short and 8,900 put to short, and then we have hedged it with 9,500 calls and 8,700 calls. Now this has resulted into a net credit into our account, and you can see if you add up all this, you will see that there is a net credit into account. That is, we are receiving some credit into our account, and as you know that the maximum profit potential is 68.5. that is, this is the credit that we have received into our account, and as mentioned before, that the loss will be little bit higher than the profit received. So this loss is higher, and this is not the suitable strategy for now, because because the volatility is not too high in Nifty right now. So let us look at some of the Greeks. We are almost neutral, the delta, that is, we are price movement is almost neutral, that it won't affect us. We are short on the volatility, that means as the volatility falls we will gain, and as the volatility rises we will lose. So that is why this option is made in high volatility environment. And similarly, we are long theta, that means which with the passage of every day it will give us money. So this is about the Greeks, and here is the payoff graph. So this, as long as Nifty expire between these two legs, suppose on 27th April, that is the expiry day, if Nifty expire between these two legs, then we are in profits. And once it starts moving down and it comes here, then it is the maximum loss zone, and it starts moving up and comes here, then it is the maximum loss zone. So this is here at these places we have to start adjusting our options so that it does not cause us loss. This is the best part of trading options, because here what you have done, just think about the strategy. You have gone long also, you have gone short also, right? And similarly, you have hedged your long and you hedged your short. So in whichever way the market direction moves, you can really go in and adjust yourself according to that. So this is a very trading options. This is a very trading options this is the biggest advantage of trading options when we are seeing with neutral and monthly schemes. So when do we close our iron condos? Generally, we have a benchmark when 50% of our profit is reached. We close our condos. So the net credit that we were receiving in this strategy was 68 rupees per one lot, one contract, one unit. So as soon as we will receive 34 rupees, we are gonna exit this strategy, because this is our benchmark. 50% is more than enough. And before expiration, anytime before expiration, we receive 50%. We gain. We make up when we make up 50% of our strategy. We are out of it. And the management of Iron Condor is done by adjusting the untested side or the profitable side of the spread. So what happens as Nifty moves? So let us see this one. So we have shorted a put and we have shorted a call. Now the Nifty starts moving up, and what has happened? You have reached the break-even point here. Now when you have reached the break-even point, what you will see that the put that you have shorted have started making profits. So you have to book profits there in the put, and you have to choose another put here to manage, and you balance your strategy by booking profit. You have to do this, keep doing this, and we can we can go as far as rolling our untested spread of the same strike out, and this creates an iron fly type of situation that we discuss in details in our courses here at Wavemetric. And this is how we manage the losses. So if you are managing your Iron Condor, you are not going to incur losses in a high volatility environment. Keep it written. It will maximum time, say 70 to 75% time, give profits in your accounts and go. So what are the similar strategies? Neutral calendar spread is a strategy that you can look into. Put butterfly, long put butterfly, and iron butterfly are the strategies, the neutral strategies, and these are also made in different levels of volatilities that we have selected and we have ranked ourselves into. So this is a very thing. Now what is advanced strategies? When we have selected iron condors, the advanced thing or the most important thing is selecting the right strikes. So this right strikes selection is important, that we discuss in detail in our courses. How to decide the volatility levels? Again, this is one more the important thing, because when you can understand the volatility highs, what are the levels that will tell you the volatility highs, or what are the levels that will tell you the volatility is low? That is more important, is deciding the volatility levels. How to adjust the iron condor? That is more important. How you will adjust, where you will adjust, when you will adjust, which strike you will choose when you want to adjust iron condor. That is more important when you are trading with iron condor trading strategies. And then morphing the iron condor, that is, suppose you have selected the iron condor strategy when the volatility is high, and during the month some event occurs in which the volatility becomes very high. Now what you have to do at that time, you have to change your iron condor strategy to a short strangle strategy or short straddle strategy, or maybe some high volatility strategies, right? So this is the morphing of iron condor strategy. What strategies we have to choose at that time, how we are going to morph our strategy, what strikes we have to choose, and how we will proceed. That is discussed very deeply there in our courses. So if you want to contact us, here is our website. Do visit it at wavemetric.com. Here is our email address. Mail us at getus@wavemetric.com. If you want to see my Facebook page, it is this page, Facebook at we have Wavemetric. You can go and search it, and this is my Twitter handle. So this is it. And of course we have the mobile application here that if you are very much an option fan, you can just check into this for option strategies, monthly option strategies, directional strategies. in this way. So this is it, guys. Have a good luck and trade well. Thank you.